Hello and welcome. You're watching Closing Trades here on ET Now. I'm Harsh Saita, with me is Snehi Shah. And let's look at how the Nifty is shaping up. Well, it's not a bad day at all, frankly, on the Nifty 50 index. We've got a good day of trade again today. Let's look at, okay, so 0.6% higher on the Nifty. Some of the top gainers, suppose there's an SBI Life perched up right at the top over there. In terms of the top gainers of the day. There's also Bharti Airtel, which has done fairly well for itself. A Grasim is doing fairly well as well, 2.7% higher on a Grasim. And Eternal continues to power forward now, 2.25% higher. First day of the week and doing fairly well for itself. And it's Reliance Industries, the big boy, which is surely the top contributor on the Nifty 50 index, 2% higher. And now we're in touching distance of 26K. We had Kunal, of course, in the morning talk about how there is a good possibility that we could touch all-time highs this week. Well, that is clearly, seemingly in touching distance given today's move. So it's surely a very, very good day of trade. Well, what's not doing as well on the Nifty, and that is BEL, Kotak Bank on the back of numbers. A Bajaj Finance as well is down around 0.8%. I'm not so sure if anyone will complain too much given the way in which Bajaj Finance has rallied. It's still done very, very well for itself. This bit of cool-off would not bother investors. 0.7% lower on an Adani Ports as well. Let's talk about the Nifty Bank, 0.6% higher despite Kotak Bank posting a muted kind of set and being 1% lower, not really weighing down on the Nifty Banking Index at all. Autos is up 0.5% as well, but really the standout is the Nifty PSU Banking Index, 1.6% higher. You also have metals 1% higher and realty 1.7% higher. Let's pull up the metal index, and especially some of the gainers on the metal index comprise some of the smaller names. Welspun Corp, Jindal Steel, Vedanta are just some of the gainers, with Welspun Corp up nearly 5% in trade. Let's also talk about the PSU Banking Index. Let's pull up what an SBI Life is doing. An SBI is doing. Bank of India, one of the top gainers there, 4% higher. Canara Bank also doing fairly well for itself. SBI is up 1.5% in trade. And you've got the Nifty Realty Index, which is also doing very, very well for itself. In fact, it's the best performing index today, 1.7% higher, with Brigade leading the pack, 3.3% higher on a Brigade. Sobha is up around 2.4%. Prestige also up 2.33%. Godrej Properties, they've got RERA approval for a 10,000 crore project, and that is also up and away, 2% higher. So Realty sticking out in trade today. But what else is, Kunal, for you? What are you seeing on charts?
Yeah, I think it's a good day for the markets, of course. Yes. With the recovery, which we sort of anticipated in the morning, and especially with the last 2 days of the previous week, where the markets had taken a bit of a corrective mode or a mean reversion as such. I think it's a good start of the week, and of course I think this should have a positive effect for the markets into the expiry day tomorrow, because I think that's going to be a very crucial parameter to look out for, because the last two expiries, the tonality in which the markets have gone into the expiry or start of the fresh expiry has carried forward for rest of the month. You started off the month of October on a bit of a positive note, and then I think from there on the entire month so far, or the series so far, has turned out to be bullish for the markets overall, with recovery across many spectrums of sectors, large cap names making a comeback, that bit of recovery coming back into the overall market breadth, etc. So that I believe could be the most significant impact which one has to look out for. Net, I think we are still holding on to that 26,000 mark thereabouts broadly for the index. Would look out for 26,250, 26,300 as an immediate target, which makes it closer to the lifetime high levels.
Okay, so looking very good. In fact, we've very mildly breached that 26,000 mark and receded slightly from the day's high, but nothing much to worry about. 25,956 is the level that we're seeing on the Nifty right now. But Kunal, the advance decline ratio exactly smack in the middle today, and it's tilting both in the favor of advances and declines, so not much happening. But India VIX, what a move on India VIX today, above that 12 mark after a very, very long time. Your reading on the India VIX?
So this is a very interesting observation. Generally we require, we generally think that the rise in VIX is actually a negative term. But many a times to break past above a resistance, you need force. And India VIX is the biggest tool in which you get a force or a much higher push in terms of momentum. And that's why I would believe that with rise in India VIX, if the sentiment is still on the bullish side, you don't have any major events which is lined up for the overall markets. Like for example, case in point, if there's a Fed policy or budget or such other kind of a major event, then rising of India VIX is a more natural kind of a focus, because the markets are going into the event with slight higher expectations that the markets could be volatile. But this kind of a rise in India VIX, led by a move on the positive side for both the indices, Nifty as well as Bank Nifty, actually indicates that this could be more of positive built up for the index. So that's why I would believe that the index could continue to move up higher on the upside, even with this slight jump in the India VIX.
6% jump on the India VIX, 12 plus on that index. Kunal, picks for this afternoon?
Yeah, so interesting names which I'm highlighting. So in the morning, I was suggesting PNB Housing as well as Ujjivan Small Finance Bank. So changed the picks to large cap names now back again. Hindustan Petro has come back into a breakout mode. The stock was underperformer last week because of the rise in crude oil prices. But there seems to be some sort of a topping out formation on the short-term charts for crude oil prices over the near term. So that could mean that we might see some bit of retracement happening over there. And that could probably lead to positive effect in the OMCs. So would look out for buy on OMCs at current levels also. 470 as a target for HPCL and stop loss to be kept at 445. Eicher Motors, a stock which was going through a correction the last 1 week, I think from 7,100, 200 levels broadly, the stock had corrected to 6,800 mark. At current levels, the risk reward is extremely attractive for short-term trades, because it seems like the stock has come back towards a major support territory. So Eicher Motors is a contra buy. Would look out for targets in the range of 7,100 and stop loss at today's low, which is around 6,840.
Okay, so those are some of the stocks that Kunal is liking this afternoon, HPCL and Aisha. But on that note, we'll slip into a very short break and keep the conversation going with Kunal as well as more fundamental experts on the other side. Stay tuned.
Welcome back. Special conversation, that time of the show where we bring in a special guest to get us a perspective on how he's looking at India. And today we have Sunil Kaul, Global Emerging Market Equity Strategist at Goldman Sachs. Great having you here, Sunil, and good chatting with you. Hi, this is Harsha. Sunil, let me start off by getting a sense as to how we're placed versus global markets. We've seen a very strong rally across asset classes and across markets. The only one that has really missed out is the India market. Is that set to change likely this year over the next 12 months?
Sure, Harsha. Thanks for having pleasure to be here. Look, I think you're right. We have seen a strong rally across many markets globally, and emerging markets, as you said, are actually up 30% year to date. India has been a relative laggard. We have been sort of explaining that by the fact that India's sort of corporate earnings have been in a down cycle for a year, and valuation starting point a year back when we took the market down were more stretched. And so the combination of higher valuation with earnings in a down cycle for a year is what has sort of caused India to underperform, whereas you have had more policy catalysts in other parts of the world. And I would say, I think to your question, we are seeing at least fundamentally signs of that sort of reversing or bottoming out, at least on the corporate earnings front, wherein after a 1 year down cycle, things have kind of started to stabilize on the earnings front. And in fact, as we have been noting in our reports, the recent quarterly reporting season has actually been pretty decent, and starting to see some upgrades, especially in the financial segment. And so our general sense is that as earnings start to recover for the market, you could see FII coming back, and India could perform a little bit better than it has done so far this year.
Okay, so that's the take on how the Indian market is structured right now compared to what the global markets are doing. Sunil, hi. Also give us a sense of this FII buying that you have just mentioned. Over the last week, except for one trading day, we have seen consistent buying coming in from FIIs. Now that we have seen a reversal in terms of the market move here, valuations have come down slightly, not a lot, but they have corrected slightly. And with the GST cut, earnings now looking better than before, at least better than the previous quarter, a lot seems to be going on in favor of India. Do you believe this FII buying that we're seeing is here to stay for a bit?
Look, we certainly hope so, because you also have to look at the starting point, right? Because if you look at the emerging market pack as a whole, we have seen close to 45 billion net inflows from the April lows, which is when the market started to rally globally. But India, as we all know, sort of year to date is still minus 16 billion. Obviously, it was 17 billion before the month started, and we have seen $1 billion inflows. But you're seeing a large selling despite the rest of the emerging market getting large inflows, right? And so your starting point is pretty low. And then if you sort of start to look at FII selling over the last 1 year, which is when the market peaked in September last year, you've seen actually nearly 30 billion of FII selling. And from all the conversations we are having with clients, a lot of the data we track, I think the positioning is very light in India. If you look at the emerging market pack, India is the second largest underweight position based on the data we look at after China. And so our sense is that allocations actually are at nearly 2-decade lows for India. And so our sense is that as earnings recover, as I said, people will need to close that underweight, and allocations could improve and flows could improve in India's case.
And Sunil, how do you view the kind of rally that we've seen in global or EM indices versus India? Is there any past trend that you've been able to extrapolate or bring out, basis of which could solidify the argument that an India market rally may well be warranted? Is there any data to back this? Is there a trend to back this?
Look, I think you have to sort of look at it in 2-3 ways. One is that you have seen, at least this year, that people want to diversify away from US equity markets. And I mean, obviously, the emerging market pack as a whole has been underweight over the last 10 years and compared to US, and that has been the right place to be in. But what we have seen over the course of this year is that people want to kind of diversify away from US to non-US markets, and that's part of the flow story which we spoke about, which is why the emerging market pack has done well. Within that, we also have to keep in mind, so that's kind of the flow story. On top of that, you look at the macro story, which is that you're kind of looking at an environment, your US growth is slowing, but still avoiding recession, and Fed is cutting rates. So the environment of non-recessionary Fed cuts is always good for asset markets, including in EM. And you are looking at a trend where we think dollar has been weakening. It will continue to weaken. We are looking at a dollar that's 15% overvalued on our numbers still. And so if Fed keeps on cutting as we anticipate and dollar remains weak, that's a good environment for EM equities. And so with the macro tailwinds plus flow story, you're set up for a decent equity market even going forward. And the third trend there is that for the emerging market as a whole, what we have seen is a rotation across the year. I think the first quarter was largely about the European markets, wherein a lot of the EM European indices did well, Poland, Czech, Hungary, because there was a lot of excitement around the fiscal package in Germany. We came to the second quarter and we saw the Fed pivoting, and we saw LATAM markets and Korea doing well on corporate reforms. Then China started rallying and South Africa started rallying on the gold strength. And where we are, and the laggards have largely been, as we discussed, India and some of the Middle East pockets. We are not as optimistic on the Middle East pack yet because we still have a bearish view on oil. But India has been the large market which has significantly underperformed. And I think the point I'm making is that we have seen investors rotating through markets as catalyst came through. And we are at a point in India wherein you are seeing an upcycle or starting to see at least earnings starting to inflect higher, and the market has lagged. As we just discussed, valuations are still a little bit expensive, but it's not as expensive as it was a year back, and flows are starting to come back in, which sets us up for a decent rally looking forward.
Coming in on the construct going ahead. But Sunil, I remember when we interacted at the beginning of the year, you had slashed the Nifty target from 27 to 2,500 or 25,000, yes, 25,500. Now that, of course, that mark has been breached, for now at least, where are you seeing the next Nifty target, let's say for the year end? What's the number that you're looking at?
Look, I mean, we obviously took the numbers down a year back. We have our numbers are largely on the back of what the underlying earnings growth is, with a little bit of compression in multiples. So our current 12-month target, which was rolled out in September, so it's a September 2026 target, is 27,300 for Nifty. So we're still looking for despite sort of the market doing well over the last month, we are still looking for another sort of 7-8% upside from current levels, which is basically driven by our underlying 12% earnings growth and a bit of multiple compression. And so we still think Nifty goes to all-time highs over the next 12 months based on the current numbers we have, but that's largely coming in from the underlying 12% earnings growth forecast we have for India this year and around 14% next year.
Sunil, would that at all surprise on the upside if the tariff situation were to get resolved? Or would there be any downside risk if at all the tariff situation doesn't get resolved? Is there any sense of that within those numbers? Can you give us some color? Because and how much of this is dependent on tariffs? Just trying to get a sense of that.
No, I think that's a great question. I mean, because fundamentally speaking, there is not going to be a lot of the earnings hit from the tariff numbers. We obviously have baked in some near-term uncertainty impact both in our GDP numbers as well as our earnings numbers until the year end. And so we do think that eventually tariffs do settle at a lower rate than they are currently. And we do expect things to be better next year than they are this year on the tariff situation. But to your question, I think if you sort of look at the MSCI India, which is 160 odd companies, only 2% of the sales are good sales are actually derived from US. And so even with large tariffs, you don't get that much fundamental hit, first order fundamental hit on numbers. Then you take a second order fundamental hit because the growth may slow down both in US and in India, and that has a second order impact. But all of that put together doesn't impact earnings by more than 2 to 3 percentage points, assuming that's a full 1 year annual impact of tariffs. But even if the quicker the situation resolves, the hit is even lower. So I think the point I'm trying to make is that, look, the fundamental hit to the earnings is not as great, and we do anticipate things to be improving on the trade front, as we just saw with China over the weekend. But therefore, to your earlier question, which is that can there be surprise on the earnings? We certainly hope so. It's not coming in from the tariff side of the equation, but it's more coming in from all the regulatory easing that we have seen through the course of this year, mostly from the RBI side, but even on the government front, as we discussed in terms of consumption boost from GST. But just to sort of mention on the monetary side, I think our sort of strong conviction is that as we go through the sort of second half of fiscal 26 and beyond 27, you should start to see credit growth improving because and monetary sort of financial conditions being easier, because you've seen a series of measures from the central banks, right, from rate cuts to sort of easing liquidity to a series of sort of RBI relaxation measures that you have seen in the latest policy and the CRR cuts, which we saw earlier in June. So if you take the cumulative impact of all of that, we do think that means financial conditions could be easier going forward, and that should start to show up in the earnings.
Okay, and another thing that we're expecting to see with the earnings trickling in so far this quarter, Sunil, are any changes, if at all, you've made to the portfolio construct in terms of where you're underweight, where you're overweight? What is your stance now on sectors like pharma and real estate? And on the flip side, staples, where you were bullish earlier, and does that conviction now increase with GST coming into play?
Yeah, I mean, it does. I mean, broadly speaking, we haven't made a lot of changes to our portfolios. Okay. I mean, we were positioned overweight financials and consumer as a cohort, and I think our conviction both from GST rate cuts as well as the easing measures I mentioned has kind of increased on those sectors. Yeah, I think the staples haven't done as well because the near-term numbers, obviously there is impact from the sort of deferment of buying around the GST-related changes. But we do think that as you start to get into the next few quarters, you should start to see improvement in consumption numbers. I mean, discretionary trends have already been starting to look better, and as I'm sure we are all tracking all the festive data points that have been coming in, which doesn't get captured in the reporting season, but they're also starting to seem very strong. And in some cases, the numbers are looking at some multi-year highs. And obviously, there's a bit of pent-up demand impact, but it does feel like the discretionary consumption is starting to improve. And then, as I said about the financials earlier, we do think all these measures that have been taken that relaxes or eases the credit constraint for the banks close to 2 percentage points of the total bank credit. And many of the measures that the RBI has taken are effective for 2027. So we think we are in a 2-year upcycle for the financial sector, and then you get consumption on top of it. So both those two sort of groups of the sectors together is a meaningful portion of the equity index. So we are overweight financials, which includes banks and NBFCs. We are overweight consumption pack, which includes autos, staples, some of the discretionary consumption. We also are overweight the internet pack, which has the tourism related theme, and so it picks up consumption as well. And we have been underweight, and we are overweight OMCs, which is more a bearish oil view. So those are the three main packs we are overweight on. And then we have, in terms of our funding areas, mostly coming in from the export-oriented sector. So we are underweight pharma, to your question, and we are also underweight industrials, ex of defense, because defense to us is still a secular theme and a global theme where companies and where countries are investing and trying to be self-sufficient. But barring defense, we are underweight the broader industrial pack and underweight some of the export segments, including pharma, because the reason for that, it's not entirely on trade, but it's more on the fact that if government continues to consolidate on fiscal and they are giving all the boost in terms of consumption, we think at the margin to make the fiscal math work, they will still need to moderate infrastructure spending, which is why we think, relatively speaking, within the market, it makes sense to be more positioned in financials and consumer cohorts as opposed to some of the exports oriented sectors or the investment oriented sectors.
Sunil, do things materially change where IT is concerned? And change maybe since over the last 6 months, has the view on IT materially changed? Because now you have tariffs in the new, as part of the new equation that you need to factor in. And you also have AI as part of the new equation you have to factor in. And how does one look at or marry these three and look at IT? Give us a sense.
Yeah. No, look, I think you're right, because the outlook on the IT sector does look a little bit more murky in the near term, because as you said, you have a higher input or higher kind of cost you need to bake in because of the H-1B visa impact. There is already a slowdown in the US economy and discretionary spending, and our sense is that the labor market in US is still weaker. Obviously, we have absence of data right now, but from all the higher frequency data we are tracking, we think the economy will continue to slow through the course of the year. And so we still have some growth headwinds for the IT sector from a slowdown in US spending. You bake in the increased visa costs, that also makes the things a little bit tougher. And then, as you said, there is the broader AI debate, wherein a lot of the investors think that Indian IT space could at the margin be impacted because of that. Obviously, we are still not at a point wherein the adoption has increased to a meaningful level across, and productivity impacts have come through across the global markets in a meaningful way. But at the margin, a lot of investors still believe that IT could be impacted adversely. I think the tougher call from a market standpoint we have is that the sector has underperformed quite a bit over the last 1 year relative to the broader market. And so our sense is that it doesn't make sense to be underweight the pack, which is why we are neutral, the IT sector, and we think selectively you may want to be positioned in some of the better related names, which also are starting to make investments in data centers and trying to be viewed as an AI player. But for a broader sector overall, we still think growth will be sluggish, which is why we are more neutral as to the IT camp.
Is the stance coming in on IT. Sunil, great to have you on board and get all of these views from you. Appreciate you joining us. Thanks so much for your time.
Thank you so much.
Okay, so that was Sunil Kaul of Goldman Sachs sharing his view on where he sees the Nifty headed, what are some sectors that he's liking at the moment, and the overall market construct when it comes to India and how it is globally placed. But on that note, we'll slip into a very short break and keep the conversation going with our experts on the other side. Hi there, welcome back to Closing Trades and earnings. That season is in full swing and we are continuing to cover managements and companies that have reported their earnings. On that note, let's get into conversation with the management of Chennai Petroleum. We have Mr. H. Shankar, the managing director of the company, joining us on the show. And Mr. Shankar, hi, good afternoon. Thank you so much for your time. Let's talk about your earnings first. From what I can see over here in terms of your revenue, it's a healthy move coming in on a year-on-year basis. EBITDA has also on a year-on-year basis turned positive, and there has been a very sharp spike in your EBITDA margins too. Help us understand what has worked out this quarter and how sustainable are these numbers for you going ahead?
This quarter, in fact, if you look at our previous quarter also, I don't want to discount that previous quarter of this financial year because we have done quite well on the operational excellence if you look at both Q1 and Q2. In fact, Q1 and Q2, the H1 part of this financial year has been the best that CPCL has recorded in its history, that we have been able to achieve almost, you can say, close to 6 million metric ton, which is almost 115% of our capacity utilization. Also, we had very excellent, the distillate yield close to 80%. We had excellent fuel and loss, which was very, very low. So we have had very good operational parameters the entire financial year of 25-26. And we also got good support from the cracks which came up in the second quarter. So, and also the crude pricing also was favorable. So overall, H1 has been a very nice half for us, and Q2 has been phenomenally good. Thank you so much.
So hi, this is Harsh here. Trying to understand how the GRM trajectory continues to shape up, right? It's a highly volatile environment, both in terms of crude pricing. We've seen, okay, so we've not seen elevated crude pricing, of course, but it's been fairly volatile between $60 and $66 on Brent. So how are GRM shaping up? Give us that sense, and what's the kind of expectation that you're penciling in?
Yeah. So let us, if you look at the GRMs per se, the Singapore GRM is the benchmark by which your operational excellence can be measured. And to that extent, I should say that against a Singapore GRM of about close to $5, we have been able to get around $9, which is a phenomenally good operational performance, I should say. And looking forward, like if you see the crude pricing also, we have had a little bit of volatility during this quarter, and we have been able to coast through with this condition also. And whatever losses we suffered on account of the crude in the previous quarter of the financial year, we could more or less, it matched almost, you can say, in this quarter also. So the crude volatility remains a factor of consideration for players like us who are standalone refiners.
And also help us understand, Mr. Shankar, what is your current amount or current percentage of crude imports from Russia, and what kind of discount per barrel are you currently realizing on these imports?
No, see, CPCL, we have almost 160 varieties of crude basket in our control. We have done a good amount of study on that, and I'm happy to inform you that during the last quarter, there were 3 new crudes that we started processing. One came from the US, one came from the Western Africa, and the third one came from the Middle East. So constantly we are innovating and we are trying to find out more means of absorbing the available markets, the available crudes in the market. Whatever is a good opportunity crude, depending on my operational requirement, we try to source that requirement. And luckily for us, we have the support of our parent company, Indian Oil, which does the bulk of the entire crude procurement for us. So we just need to be very aware about the market dynamics. We need to be aware about our operational requirements and place it to Indian Oil for the crude procurement. And to that extent, I should say that during the last quarter, we have done new crudes, we have done the Middle East crudes, we have done about opportunity crudes of about less than 20%, 15% or so we have done. And we have a very flexible and a very robust kind of a network by way of which we can manage this crude volatility.
And sir, talk to us a bit about capex as well. What's the pipeline looking like for the rest of the year? Also, with regard to modernization of the Cauvery Basin refinery, how is that kind of shaping up? Give us a sense.
Capex, we have, as you are aware, we are now venturing into a new business, altogether new business. There's a retail outlet business that we are doing. And that's a very strategic move for CPCL because as a volatile, as a standalone refiner, which is subjected to a lot of volatility in the prices of crude and products, this kind of this retail outlet business kind of acts as a mitigation measure. It provides us some kind of a cushion against the volatility of these elements. However, that is also a new element for us because CPCL in its 60 years of journey, we have always been identified as a standalone refiner. So venturing into the retail outlet business gets us better visibility across the country. And this product, what we will be dispatching through our retail outlets, we want to maintain a different identity. We want to give emphasis on the service parameters. So that is one important project, which is a capex oriented, around 400 crores has been earmarked for this retail outlet business. Apart from that, we have got another approval for setting up a Group 2, Group 3 LOBS project, which is a lube oil base stock project. We are already manufacturing the LOBS 1, which is a Group 1. But now we will be venturing into a new area also, which is a Group 2 and Group 3, which is a good import substitution and also a risk mitigation against the diesel volatility. So we are looking at a couple of new projects which are coming up, and also we are very enthusiastically looking at some low-hanging fruits which can give us good result with respect to the value-added products. Now, with respect to Cauvery Basin Refinery, what you are talking is a joint venture between CPCL and IOCL. And this project was configured in the form of a fuel-based refinery. Now we are relooking at the configuration to bring in a better element of higher element of petrochemical intensity in it. Earlier, we were thinking that we will venture into the petrochemical intensity in the second phase of our project. But now we are trying to advance that second phase to the first phase itself. So we are looking at a reconfiguration of the project, and we are also discussing with Indian Oil and the state government to finalize what kind of ventures we can do, what kind of incentives can be available. So we are tweaking the configuration, and maybe in a couple of months' time, there will be more clarity on this journey.
Okay, so that's the take coming in on your capex front and the outlook going ahead. Also, Mr. Shankar, in the last call, you had mentioned that the impact of maintenance shutdowns in FY26 will be lower than what we saw last year. On the basis of this, what level of throughput or capacity utilization should we expect to see in FY26 compared to the previous year?
Yeah. I'm very happy to inform you that we have completed one turnaround. Like we took this turnaround towards the end of Q2, and now when we enter into this October regime, we have just completed our turnarounds. So that gives you a confidence that we are now in a better position in Q3 and Q4 to ramp up our production. We are also in a position to have higher reliability of operations. So we have completed all our turnarounds for this financial year, and we are looking forward for a robust physical performance in Q3 and Q4. So if you ask me, my desire is to see that we have already achieved 115 or close to 115% capacity utilization in H1. So if not more, at least the same level of performance I would like to see in the coming half also.
Before we let you go, Mr. Shankar, just one last question on your revenue target in the near future and the next few years. Is there any ballpark number you're targeting?
The point is, we have done 90,000, we have done 80,000. So as you see, we have revenue, we had set a target of being 1 lakh crore revenue. That is what we are looking at target for in a couple of months, for a couple of years' time. Of course, it's a very long journey, but of course, we are also looking at some value-added products. We are looking at some kind of diversification. We are looking at the retail outlet business. We are looking at various other opportunities available to us so that we are able to achieve that 1 lakh crore turnover, which would be a big boost for CPCL's future. So that is, if you ask me, that is what we are setting ourselves as a target.
Okay, so that sounds optimistic. 1 lakh crore in terms of revenue, Mr. Shankar. Good luck for that, and we'll interact with you soon on that as well. But thanks so much for your time.
Thank you so much. Thank you so much.
Okay, viewers, on that note, we'll slip into a very short break, just taking a look at what the market is doing right now. Less than an hour left for trade. You have market right now at 25,945, so around that 950 mark. No material change since we last saw the market, about 0.6% higher. India VIX has cooled off quite sharply right now. It's below that 12 mark. It was up about 7% when we last spoke about it. Has cooled off significantly, is now up about 3.4% as we speak. Nifty Bank continues to look resilient. On that note, we'll slip into a very short break and be right back with more on the other side.
Welcome back. You're watching Closing Trades here on ET Now. And quickly on to one of the bigger stories of the day. Vodafone Idea, Supreme Court disposing of that appeal, sending it back to the government for reconsideration. Of course, it's a large AGR due of around 83,000 crore, which needs to be considered. Plus, you've got interest, penalties, and the like. And you can let's pull up the Vodafone stock as well, get a sense of what that one is doing. At least was up for a better part of the day in trade. In fact, did very well in terms of a move even on Friday. Well, it's up 4% as we speak. Kunal, of course, was bullish with regard to Vodafone Idea. Kunal, what next for this one?
Yeah, so I think we penciled 10.5 as a target for Vodafone Idea. Today, I think the stock has managed to hit that level. I think now there should be some bit of cool off over here, for the prices, because once the event is out of the way, you expect the the traders to try and wind up the positions or close the positions on the anticipation of the event, and then the stock gets into a zone of minor consolidation. So I think I would now look at near-term dips or maybe a mild correction, which could come by as a good opportunity for short-term traders to look at a buy. But I strongly believe that I think what we are looking out for is a major breakout on the weekly, monthly charts for Vodafone Idea. So I think I would probably expect that near-term wise, you might expect the stock to cool off a little bit. But I think on the longer-term basis, monthly charts over the next 6 months, 1 year, I think the stock should continue to move up significantly higher.
And Kunal, Bharti Airtel is the other big mover. So of course, Vodafone, well, take money off the table is what you're saying. What about Bharti Airtel?
Yeah, I think Bharti Airtel continues to be one of the stronger players and stronger stocks in the telecom pack. I think it's done fantastically well. Even at the point when the stock has crossed the 2000 levels, we were discussing, I think last week, that the stock is stuck into a 150 odd point range, 180 point range to be precise, over the very near term. 2060, 70 is a breakout point. It seems like today that the stock is showing those classic confirmation signs of a breakout. So Bharti Airtel, I think, continues to be one of the stock where traders could continue to have a bullish stance even from current levels. And I think to add maybe one more stock, Interstar is the other name, which also looks very attractive at current juncture, especially with the fact that the stock has already gone through a major correction through the last, I think, 8 or 9 months broadly. So I think at 360, 70 thereabouts, Interstar could be the other stock from the entire space to look at.
Okay, and Kunal, while we're on the telecom topic, Bharti Hexacom, that stock up 5% today. What is your take on Bharti Hexacom on the charts?
So again, a very interesting chart over here, Sneh, because Bharti Hexacom went through a grind in the first or in the mid part of this calendar year from 2000 levels towards almost 1650 levels where the stock had corrected. So a decent correction of almost 18-20% for the stock, and now it's come back into a reselective mode. The volumes are looking attractive, a tad bit more attractive for Bharti Hexa at current levels. So I would believe that that could be an indication that the momentum would continue. But these are the kind of stocks where you have to have a time frame of at least 3 months or 6 months for the trends to play out, because these stocks have a very odd tendency of going into like 2-3 weeks of sideways price range, 30, 40, 50 point range for a very near term kind of a trend. But then eventually over the period of 3 months, 6 months, you gradually see these stocks starting to show signs of trend and then a continuation breakout. So Bharti Hexacom, I think, is a stock which falls in that category.
Okay, so that's the take on Bharti Hexacom as well. Let's focus once again and talk about Vodafone, the stock in focus today after a partly favorable Supreme Court outcome, if you can call it that. We have Mr. Balaji Subramanian, the VP at IIFL Capital Services, joining us on the show. Mr. Subramanian, hi, good afternoon. What are you making of this verdict that we've seen coming in from the Supreme Court in terms of that 9,450 crore additional AGR dues that they have said now the government can decide what they want to do on this front? They've allowed the government to reconsider. Your take on this outcome?
Good afternoon. Thanks for having me on the show. So I think the biggest positive here is that the Supreme Court has finally given the go-ahead to the government in terms of the steps that they can take with respect to providing any relief to Vodafone Idea. Because remember, all these years, one big issue was that the government's hands were essentially tied because at the end of the day, you wanted to operate within the ambit of the Supreme Court judgment, the 2020 judgment. Now that the Supreme Court itself is fine with the government going ahead and providing any potential relief measures, I think now the government has multiple options to consider. One could be, obviously, even without the Supreme Court intervention, they could have gone ahead and extended the moratorium further because the existing moratorium expired on September 30th. The other option is that they could extend the timeline of the AGR payment because the original order of the Supreme Court said that these payments would have to be made by 31st March 2031. And the third, the bigger relief could be if the government goes ahead and waives off the interest penalty and interest on penalty on the dues. Because if you recollect, these items were almost 75% of what the total liabilities were. So to that extent, if Vodafone Idea today has a little over 80,000 crores of AGR liabilities, the interest penalty and interest on penalty itself adds up to something like 60,000 crores. So if the government were to move in that direction, then I think there can be a meaningful relief of both on the balance sheet and cash flow front for Vodafone Idea.
Balaji, therefore, given this positive, what changes for you in terms of your estimates, both on the earnings front? Does it give you, if this were to come through, will it give you more visibility with regard to can Vodafone turn a corner, perhaps even look at profitability or a positive PAT? Is that something that you would keep on the table if this were to happen?
So I think positive PAT is a long way off. I think the way it might play out is that with this kind of a cash flow relief that can potentially come, assuming that the government acts and there is an extension in terms of the payment timelines and the moratorium itself. That means that the prospects of Vodafone Idea's debt raising meaningfully go up because they have been attempting to raise 25,000 crores worth of debt for over a year now. And the lack of clarity on the AGR matter meant that they have been unable to do so. But if the clarity comes on this, I think their debt raise program should go through. Once that comes in, they will continue with their capex program of the 50 to 55,000 crores that they had originally announced last year. And on the basis of that, I think they have a better chance in terms of defending their market share. So that is how it should play out. Now, the path to profitability depends on a number of things. For that, the most critical thing is that they continue losing subscribers, which they have been losing even until the latest TRA data, which was for August, as we saw. And then I think the other way to play this would be through Indus Towers, because as I said, once the capex program of Vodafone Idea resumes, then Indus will be a direct beneficiary because Vodafone Idea would have to increase their 4G coverage, and that is where they would require more towers. So Indus will be a clear beneficiary from this, and there is also an angle of the reinstatement of dividend by Indus.
And Balaji, help us understand, now that the government owns about 49% equity in Vodafone Idea, what does that tell you about the neutrality in the sector? And does this judgment today or the verdict today open the door for other telco players as well who have AGR dues case pending, but where the government does not have as significant as a stake as it does in Vodafone?
I think it would be very difficult for the government to only extend the benefit to one player while denying the benefits to the others. So the others here mostly pertains to Bharti Airtel and Hexacom, which is anyways a part of Bharti Airtel, because Tata, anyways, they have they are no longer operational. So I think it would be very difficult for the government to give any preferential treatment to Vodafone Idea just because it holds 49% in the company. So I think the benefit should be to both the players. Of course, in terms of the incremental benefit, it will be a lot more for Vodafone Idea because they were the ones who desperately needed this. Bharti already has a very strong cash flow profile, and that should further get strengthened, based on today's verdict, and assuming the government kind of provides an equal treatment to both players.
Okay, thank you, Balaji. We'll leave it at that. We'll let you go on that note. Of course, that big development keeping Vodafone as well as the telco pack in focus. Even an Airtel is up nearly 3% on the back of that. But what we'll do is we'll step into a very short break. On the other side, we'll continue to talk stocks. Stay with us here on ET Now. Welcome back. We are tuning to you live from the SBI Live studio, and that on the show where we bring in more analysts to give us a sense as to how markets are playing out. And Mayuresh Joshi, Head Equity Market Smith India, joining us. Mayuresh, good afternoon. Great having you here. Mayuresh, something less spoken about, in this market is infra plays, because we've seen the order pipeline not come in as robustly since the elections last year. Do you believe that order books, though, and most of these companies are sitting on multi-year order books? Let's pull out an NCC. Let's also talk about a GPT Infra. They're sitting on multi-year order books, and therefore, do you believe that maybe this bit of pessimism on order inflows is a concern at all? Or do you just believe that the opportunity is still huge, especially in the infra space? That's my first point. Second, how do you play it?
Afternoon, Harsh. Two things. One, I think in terms of how the orders will play out, the large expectation is that over the next few quarters, the next few months, the next few quarters, orders will keep on coming through because there is a budgeted central government expenditure in plan, specifically in terms of high-intensity capex projects. And therefore, if there are orders which are lacking right now, I think it should be made up as we head into the fourth quarter. So I think orders related to urban and rural affordable housing, as an example, ports, roads, railways, metro coaches. I think there is a whole spectrum where orders can probably come through. So to answer your question, I think just a little bit for patience in terms of more orders coming through, both in terms of the central government bidding, in terms of tender-based orders, or otherwise as well. On the other side, in terms of how do you play this, obviously, I think the best play here is going to be L&T because it's a complete play when it probably comes through infrastructure, hydrocarbons, new energy, defense. And therefore, I think that probably becomes a no-brainer. Any decline on this one obviously becomes a good buying opportunity. The expectations in terms of slow-moving orders coming off the balance sheet, they're executing well, whether it's the domestic operations or the international operations as well. And therefore, working capital probably remains in control, making us believe that ROEs will show expansion in the next few quarters. Similarly, I think power as a space should continue doing well. And therefore, I think both in terms of generators, transmitters, as well as EPC players, there are a clutch of players that can probably do well. So my own sense is that there's like an NTPC from the large cap names or the PSU names, Tata Power from the private names, where there is huge activity happening in terms of renewables, is something that can be carried on in terms of numbers and regulated ROEs actually holding up for a few of these PSU names as well. At the same time, I think companies like a Power Mech solution, as an example, it has run up too much. But again, I think the kind of work that they're probably doing, not just in the power space, but also in terms of refinery as a business, and where government capex is expected to continue being very, very strong as far as new energy is concerned, hydrocarbons is concerned, and obviously renewables is concerned, shall continue doing well. The third aspect obviously can be railways, and therefore I think the expectation in terms of more orders coming for the sector as a whole is something that can continue happening at a decent pace. Texmaco Rail, Titagar Wagons, where the expectation largely in terms of the tendering that they're probably doing in terms of wagons, and the tendering again in terms of servicing all these aspects going forward as well. I think there's going to be a multiplication of effort that probably comes through once the wagons are made. Last but not the least, I think certain housing finance companies which are catering to rural and semi-urban areas might also continue doing well. And yes, the names that you probably mentioned within the infra space, NCC as an example, you've got Pennar Industries as an example. I think they've got a good business model which can probably ensure that if they execute well, numbers will keep on showing up in the balance sheet. The only caveat, Harsh, here is that you need to have a long-term view as far as infrastructure is concerned. So if you're having a 2 to 3 year view, all these stocks can give you decent returns.
Kunal, housing finance. Been a while since we spoke about that clutch of stocks. Anything that interests you within that pack from a technical perspective?
Yeah, so PNB housing is something which looks attractive on the short-term charts, and I think a slew of these stocks, I think they've done reasonably well. You look at the likes of L&T Finance, etc. I think these stocks have done spectacularly well on a YTD basis, and I think riding through the major parts of market volatility in the last 8-9 months of this calendar year, I think is the hallmark for many of these NBFC stroke HFC names. So I strongly believe that this is one pocket which has emerged in this kind of a market, after maybe months or, the previous couple of years of underperformance, for the entire sector as such. I strongly believe that this could be a potential multi-year rally for many of those stocks. So I think over here, the idea is to look out for the leader stocks and the ones which have performed very well for themselves as more long-term bets. And then you'll have those phases where the underperformers or the ones which have underperformed significantly many of the other peers, I think they could keep on making those odd comebacks in between. So that could be more of a trading bet in the underperforming pocket from the entire HFC space.
Yeah, now SRF, the numbers came out, stock was 2.5% lower. You've seen a bit of a fall on the stock price. Quickly looking at the numbers themselves, and of course they've been flashing since a while, but we've come to it just now. 3,600 odd crore was where the top line was. Expected at around 3,850 crore. That was broadly the number expected. EBITDA came in at around 775 crore versus the 825 crore number. So quite low in that sense. You also saw PAT come in around the 388 crore mark as seen on your screen, while the anticipation was around the 430 crore number. So that's quite a miss. So 2.5% lower on an SRF. Mayuresh, when do these chemical companies recover, and is there an opportunity? Because it's been a prolonged cycle of pain. When does the cycle turn, in your opinion?
I think still a quarter or two away, because I think China still remains weak, Harsh, and I think that's the major driver in terms of global demand and supply as far as chemicals are concerned. And let's not forget that there are major suppliers of chemicals as well as far as dumping in a lot of global markets are concerned. So for SRF in particular, I think the numbers have just come out, but I think a more interesting aspect here are going to be the fluorochemicals business. How are they ramping up the fluorochemical business? The current demand and the new supply of R467A, which is set to replace R22. What is the kind of demand dynamics that are coming through? On the packaging side of the business, there is intense competition coming through from China. And therefore, I think what happens to its Thailand business, specifically in view of Chinese competition, is going to be extremely important. Both the BOP and the BOPET business, I think both pricing as well as demand is going to be extremely critical. On the technical textile business, specifically, I think the healthy demand that you might see in the polyester tire cord fiber segment might probably ensure that it does well, but it might get offset by the nylon tire cord segment. Therefore, I think how these numbers and management commentary play out on these aspects need to be seen. But one needs to be really very, very careful. I think we've just got a couple of chemical names in our model portfolios, both locally and globally as well. One is an agrochemical name and one is a pure play chemical name, but they have all run up quite significantly. So again, I think we'll have to wait for declines and be very, very stock specific in this space.
That's a take on SRF, and the stock continues to fall. It's about 2.5% lower now as we speak. We have the press release wherein the chairman and managing director, Mr. Ashish Bharat Ram, is saying that they have been dealing with very uncertain global environment, but they remain confident for a good finish to the year. The chemical business has reported an increase, but other than that, performance film and foil business has experienced a marginal decline. Technical textiles business, this is a pain point for the company, 11% decline, and other businesses also see seen a 19% decline on a year-on-year basis. In terms of their capex, they've increased the guidance from 595 crore to 745 crore, and they've aimed to complete this by December 2026. So that's the press release coming in from SRF, and that stock continues to fall 2.5% lower as we speak. But Kunal, your take on SRF on the charts? Do you believe this cut is a good time to just buy the stock now?
Yeah, I would not be bearish on the stock for SRF, and I think the correction which you've seen in the last 3-4 days, almost like a 150-175 point retracement, should actually be considered as a good buying opportunity. The volumes today, of course, on the higher side as compared to the volumes in the previous leg of the rise for SRF, and start of October, in fact, the stock was at 2,800. From 2,800, the stock moved up to 3,200. So it's managed to absorb, it's acted as a cushion for the stock to absorb the negative price action post results for SRF. I broadly believe that the chart structure is quite bullish for SRF. And in fact, it's one of the only formidable names from the entire specialty chemical pack. I think at one point where you have names like Aarti Industries, etc., which have been underperformers, this has been one stock which is moving up into its own trajectory on the upside. And I think, if I'm not wrong, just recently, almost like a month or couple of months back, the stock was perched very closer to its lifetime high levels of 3,300 thereabouts. So I think the chart structure for SRF looks to be on the bullish side, and this dip post results, I think, should be taken as a buying opportunity.
What about some of the infra plays here, Kunal? GPT Infra has perked up 10% in trade. You've got NCC, which we spoke about this morning as well. How are some of these names looking on charts?
Frankly, they are still into an underperforming territory, Harsh. So, when I look at the charts for NCC, GPT Infra and such other names, the last 5-6 months of chart structure is very dismal, to say the least. And for these stocks to make a comeback, you don't require, you require more than just 1 or 2 days of strong price action or maybe a decent volume action. It needs to have a strong follow-through up move. That's the one which is missing for many of these infra names. So I would believe that I would look at this more as a very, very short-term trading-oriented rally. If you get 5%, 10% kind of a swing upside for these stocks, that's at best, which I would believe could be taken as a good profit booking opportunity rather than creating fresh positions, expecting these stocks to trend up higher.
Okay, so that's the take on NCC, some of those infra plays. Mayurish, want to get your sense on some of the high buzzers in today's trade. Eclux is up 7.5%. Surprisingly, RR Cable is up 6% at a time when copper prices are also surging. Is this just on the anticipation that the entire cost is going to be passed on to the consumers? And what is your take on the entire wires and cable segment right now?
So the organized players might do well, absolutely use well. The expectation largely is that with copper prices spiking up, I think a large part of the inventory consumption that they've probably done till the end of Q2 should largely be done and dusted with. And therefore, I think even if the cost probably goes higher, they'll be able to pass it through, which will have a minimal impact in terms of their margins as well. On the other hand, the expectations in terms of domestic demand remaining very, very strong, and specifically in terms of the organized market and organized players within the organized market gaining more market share is something which makes us believe that these players might actually post better numbers as we head into Q3, Q4, along with the expectation largely that is getting set in of more orders coming their way as infra spend and infra push through probably happens both at the central state and the private side as well. When it comes to the IT sector as a whole, I think our sense is that a few of the mid-cap IT companies have given decent numbers, including Eclus, including LTIM, including Coforge, Persistent. And therefore, I think if you probably look at a cohort within the IT universe, I think mid-cap IT players have given relatively better commentaries. They probably look a little bit immune in terms of pricing as far as mid-sized companies are concerned. And therefore, I think the expectation in terms of orders coming through with decent pricing will mean that margins should probably sustain going forward. A lot of efforts that are probably being undertaken at this juncture and underpinning the entire expectations of IT when it comes to AI. I think a few of these companies have actually done good strides as far as the entire space is concerned. So I think we believe that out of the numbers, I think LTIM, Eclux had a decent share. Emphasis is something that doing a great job.
Well, flashes on your screen. 6 units have been approved under the Electronics Component Manufacturing Scheme. You want to start looking at what could well get impacted by this. Let's pull up something like a Dixon Tech, see whether at all that one is reacting. But we'll have to wait and watch as to more details with regard to who this impacts. So we'll await that. And while we do, let's take a...
Just a second, sorry to
Sure.
interrupt you. There is a sharp spike coming in on Keynes Technology right now.
Correct.
0.8% uptick coming in on that stock. So just pull up Keynes. I want to see the kind of uptick that's come in. Yes, Sirma SGS2. Let's see if the stock is reacting, because you do see an uptick coming in on Keynes Technology, and we'll just see what Sirma SGS is also up to. Okay, that stock continues to be under pressure. No recovery, but yes, 2.5% cut. We'll give that news some time to settle and for the market to absorb it. Let's see on the other side of the break if these stocks are still continue to be a buzz, Harsh.
But one more piece that we need to keep our eye out on is the Election Commission. The Election Commission of India is set to address a crucial news conference at 4:15 p.m. in Delhi. The announcement has attracted a lot of attention in political circles as well. Reports suggesting this briefing could set the stage for EC's planned nationwide SIR exercise. Now, while we'll track that closely, you want to tune in at 4:15 because we will give you live coverage on that and on what's playing out. But the other piece, Kunal, is realty. The stocks within the realty space doing fairly well in trade on a day like this. Do you like realty as a space at this point? Because we've seen a sharp pullback from the highs of the last 2 years. But what next for realty is what I'm trying to get from you.
Yeah, I think it's a very attractive space, frankly, Harsh. And I think at current levels, you have to look at few stocks from the realty pack. Godrej Properties, for example, has given a very big breakout. We've been bullish on the stock in the last, couple of weeks. DLF, I think at current levels of 750, 770, 780 thereabouts, I think is also a very attractive chart. Oberoi Realty on the short-term basis has given a breakout of sorts. So when you have Prestige, I think at 1770 or 1750 levels thereabout, had confirmed a swing breakout after weeks of underperformance for the stock. So it's one by one, many of the stocks in the entire realty pack, which is making a very good comeback. That should augur very well for the sector overall. And I look at it this way, that the realty index is still far away from its very recent high. I think June, July highs, for example, I think if I'm not wrong, it's still 10% or 15% off its recent swing high. Forget about the lifetime high levels. So I think in that context also, you are looking at a space which could recover another 5 to 10% at least in the next 3 to 6 months.
There you go. Those flashes taking care and giving context as to why a Keynes Tech is in focus. Keynes Tech, one of its facilities is that which is approved under the Electronics Manufacturing Scheme, the EMS. Keynes Tech will be making multi-layer PCBs in Chennai, Tamil Nadu, and that one seems to be one which is approved. SRF will start a line of production from March with a cumulative investment of 496 crore. Okay, that's on SRF, of course. Now, one more piece. Very quickly on to Mayuresh. Mayuresh, what's the sense like on realty? Do you like realty from a fundamental perspective? Sometimes when you're looking at realty, 3-4 year execution timelines, debt is considerably lower than in past cycles. Growth seems to be sustaining despite the fact that house prices have gone up. It's still sustaining decently well. Your take on realty, is this a space which you two are bullish about? At least Kunal is quite bullish.
No, selectively, yes. And again, I think the expectation largely here is that select players will keep on doing well, both in terms of the pre-sales velocity, in terms of new launches that they'll probably do, and expectations in terms of the earlier and existing inventory probably getting consumed as we head into the next few months and next few quarters as well. So pricing expected to remain stable, as you pointed out. They're carrying out a very asset-light model in terms of expansions as well. Some JDAs are probably happening with a few other developers or a few other interested parties as well, which reduces the leverage component onto the balance sheet. And therefore, I think which pocket are you probably catering to and how the demand is stacking up and expected to remain so is something which is going to be very, very interesting. And therefore, I think a stock like a DLF, as an example, is something that we continue holding in our global portfolios. Phoenix Mill seems to be a very good proxy in terms of the entire space itself. I think the kind of fit outs that they probably have, the expectations in terms of escalations, specifically the ones that are coming up for renewals over the next 12 to 24 months, seem to be on track as well as the capex that they're probably doing, both in terms of their hospitality chain, as well as their core properties in a few cities that they're probably intending to open up, both in the south and the north in the next few months. So continue holding DLF, remain optimistic on Phoenix.
Yeah, what about a Keynes Tech, Mayuresh? This PLI approval Give us a sense, where does it stack up? And also, I know maybe it's a follow-on question to the realty index, but just tell us whether there are certain names that are standing out for you right now. DLF is something you've bought some time back. So follow on realty and Keynes if there is a view. Very quickly.
Well, so as I said, Phoenix and from the realty space, I think watch out for this one. When it comes to Keynes specifically, I think the PCB part is something that they are adept at doing. So if you look at their presentation or even their annual reports or their earnings transcript, I think the presentation is the best way. I think they've got 2-3 slides which actually explains you the entire PCB process. So they're very good at doing the PCB part. I'm more interested in knowing how they're evolving in terms of the ODM play. So the original design manufacturing is where margins are higher. As that play evolves over the next few quarters and a proportion of that starts increasing in terms of revenue and EBIT contribution, I think you'll start seeing some element of numbers actually improving drastically, and a re-rating that will probably happen. So it's going to be very interesting to observe these facets that happen with Keynes.
Okay, thank you for that, Mayuresh. We'll let you go on that note. Thanks so much for coming in and speaking with us and giving us all of those views. 0.7% higher on the Nifty 50 index. We are just about at close, inching towards 26,000. Not breached, but we have made very good progress, I would believe, and we'll take Kunal's view on the progress we've made today. Now, let's go across to Snehi with the market wrap.
Well, yes, quickly wrapping it down for the day. About 30 seconds of trade left. Your 0.7% uptick coming in for the Nifty, inching closer to the 26,000 mark. The advance decline ratio slightly once again tilting in the favor of the advances. India VIX has been a mover and a performer in trade today. The broader end of the market has outperformed the benchmarks, with sectors like PSU banks, realty, metal, bank, auto, energy, IT and FMCG doing well. On the flip side, pharma and media stocks were under pressure. The big buzzers today, Keynes on the back of this recent news flow. You had SRF on the back of its earnings, Vodafone Idea on the back of the AGR dues outcome coming in. So lots of stocks to watch out for. Other than that, you have eClerx that has done very well and will be interacting with the management tomorrow, followed by RR Kabil, Aether Energy, Bharti Hexacom, Intellect Design, Aditya Birla Real Estate. All of these stocks to watch out for. On the flip side, Zen Technologies, Cohance, SBI Card, Gujarat Fluorochem, Wockhardt and Adani Power continue to be under pressure. So that is how we're winding down for the day. But Harsh, back to you for closing comments.
You've got 3% moves both on an SBI Life and a Grasim. Bharti Airtel up 2.5+%. SBI 2 up nearly 2.5%. Some fabulous moves at play today. Kunal, what's the take on the index? What should we look forward to for tomorrow? More gains on this to be built up on this, what we've seen today in terms of a move?
Yeah, I think we should start playing the ticker of how far we are from the lifetime high levels.
That's true.
For the indices, because I think the mood is now set in. You know, so many indices making new highs on a regular basis. PSU Bank Index, we were discussing this offline, just
yes.
I think 10-20 points away from a lifetime high levels.
Correct.
Private sector banks have done it. So I think the context and the floor is set for the markets to now come back into a breakout mode. And I think tomorrow being the expiry day, you might expect some bit of volatility, but the direction, the trend is set on the upside.
Let's pull up the Nifty PSU Bank actually. We had to take a view on that. We fell short on time. The Nifty PSU Banking Index saw a bit of a spike right at the end. And let's pull up some stocks within that index as well. SBI was the one which actually led to that spike. But outside of that, let's pull up a Canara Bank. I want to see what has happened there, whether we're seeing similar spikes on Canara Bank, PNB, Bank of India, Bank of Baroda. Let's pull up some of those and you can see those small spikes across the board. Kunal, any favorites within this pack?
Short of choices, actually. There's too much. There's plenty.
All of them are favorites.
All of them are looking at
So which ones to avoid then?
So I think at this time, it's always better to try and concentrate on the more liquid and the most solid ones. So
Sure.
of course, I think in that sense, SBI is the top candidate. The stock is now almost at 930.
Yeah.
It's closer to that 1,000 levels. I think the next set for the PSU banking names lands up to be the likes of Bank of Baroda, PNB, Canara Bank. And as I said, the list is very long.
Right. And what about the private banks, Kunal? HDFC, you've been bullish on that since a while. The move has been okay, but
Yeah.
but still more, dil mange more.
Yeah, they'll mange more, but you know, I think now it's a zone where you have the PSU banking stocks which are outperforming.
Sure.
This zone will continue for some more time. Once this zone goes into an overbought, that's where the money will come back and flow back into the private sector banking names. So you'll have to wait.
Well, viewers, Kunal and me can chat all day. So that is obvious. But what we'll do is we'll close for the day because markets have closed. What we will do is we'll continue this conversation tomorrow morning. But for the moment, from all of us who put this show together, thanks so much for watching. Stay with us here on ET Now, programming to continue.